Hi, Randy. Oh, you're muted.
Gotcha.
Getting you loud and clear, though. That's good.
You know, I got a headset from our IT people, and I brought it home, and the plug worked well at my docking station at the office, but it doesn't go into my laptop. So I'm going to have to go with what I got here, which is, if I have any voice problems, I'll dial the phone number
Yeah.
on the Zoom call and just use my cell phone for voice here.
Perfect.
So we're up to 21, all kinds of backgrounds, Vic. They spread this out pretty good amongst the not-for-profit community. So there's 5 or 6 people that I think came as referrals from the Community Foundation. A lot of businesses here: Mountain Architects, Vacasa, Central Park Management, Community. Let's see, Yampa Valley Tire Pros might bring a couple people. A couple startups here too. Replenish IV Therapies, Don Cook. Anyhow, Steamboat Stars. Couple people I don't know. The Holiday Inn sending somebody. So, it's a nice mix.
It is a variety. That's good. Good deal.
So, do you want to just kind of introduce this as host of it? And
Sure.
Give a shout out for the chamber real quick.
Yeah, absolutely.
Cool. And then let's get together maybe next week or the week after and talk about December's marketing program and see who we want to recruit to teach that, because I'm not up for that. So
Okay.
I'm sure we can find Kayleen or Leslie Murphy or somebody like that that'd be happy to do a program and get a little PR.
Sure. Yeah, I would think either one of those would love it.
Kayleen's doing her own thing online. She's asked me to send some referrals out, which I'm happy to do. So she sent me some seminars she's going to try to build her on her own in the next few weeks.
Okay. Okay.
Is she a chamber member?
Yes, she is.
So I'll be working through PowerPoint. It's really kind of out of a textbook that I've taught from years on understanding financial statements. I've only really added a couple slides. I took a couple out too. My goal is to finish at 7:30. If there's a bunch of questions and it goes a few minutes long, that's no problem.
Yeah, no problem with me. So excellent. I'm pumped we've gotten this many. I kind of figured that this one, the financial statements, would be of interest to quite a few people, especially in town here.
There's a lot of people that, didn't go to business school and need a little help in that area for sure.
Absolutely. It can be pretty confusing, but also a little, it can, I don't know, can be a little intimidating, I suppose, too, especially if you get on a board or something like that and suddenly have to start looking at them. So,
yeah. I will, I wrote all the contacts down here, but I think I wrote them in reading that you can get, and I'll give you all these emails, scan them and give them to you. So you have you can send them a thank you or whatever on behalf of the chamber.
Cool. Thank you. Well, this has been great, just this series. So after December, if you want to do another one next year or something.
Yeah, I'll probably take January off, but yeah, I wouldn't mind doing a couple more and maybe bringing an extra speaker or two from the outside on topics I'm not that good on.
Yeah, definitely. I know we've had some people reach out in the past that kind of maybe for in-person meetings didn't make a lot of sense, but I think on at least the virtual Zoom stuff, you can throw a couple other topics in there that maybe you wouldn't do, for an in-person meeting.
Yeah, we can
see if you get people to show up, because if only 5 do and you've still got a recording, it's still helpful.
I've got one a recording up for that new business planning that I'm planning on doing in November already, but there's some advantages to doing it in person, questions, right, dialogue, and I don't expect those particular seminars to have more than 5 or 10 people, but they all want to start a business, and having some interaction with them, I think maybe an advantage. I don't mind if people see my recording, but I like having the interaction, and encourage him to go to, mentoring and things like that afterwards.
Sure. Sure. Yeah, and the Q&A is nice too. But we plan on putting this one up on our website. We've saved recordings. I didn't do the last one because we weren't able to finish it, but I'll do this one.
Okay. Well, hopefully we can finish this.
Yeah, I'm sure we will. We're off to a better start, that's for sure.
Were you in Montana when we did the last one?
Yeah.
Oh, okay.
Yeah.
Yeah.
Yeah, I was in Montana in a hotel. I was getting great internet and everything. So yeah.
I did the last one from work, and I was thinking just, some weird thought that maybe they were doing some big download or something like that that impacted our bandwidth, but it could have been you up in Montana because you were the host.
I suppose, although I don't know, everybody was able to hear me and I could hear everybody.
Mhm.
And it was just suddenly it just went out. I didn't think to have you try to call in at that point in time
Me
on
neither.
the number and mute it, but that may have worked.
Mhm.
So
Yeah.
well, either way, we're all local now, so all here at home. It's nice to see the smoke clear out.
Yeah, we were just watching the 5 o'clock news, and Fort Collins is getting it really bad today. This wind really kicked up that Cameron Peak fire, and
Oh, really?
they're starting to vacate all the homes, tell people to leave in the foothills outside of Fort Collins. So it's getting a lot closer to the city.
Wow.
Yeah, wow.
That thing has moved so far. I mean, because it started almost at the pass, or it did start at the pass,
Mhm.
and has moved all the way east. That's crazy.
Hi, Dawn.
Hi, Dawn.
You're first here. Congratulations. Tell Coleman to do the dishes too. But mostly it's to keep score of your progress. Set goals, monitor goals, know how you're achieving your objectives. It's kind of like a game. I think baseball without keeping score, without watching the statistics, is pretty darn boring. Business can be boring too if you don't keep score. How are you doing on sales? How are you doing on your profit margins? How are you doing on your markups? Are these things sustaining, growing, declining? We're going to talk a lot about, maintaining a set of progress reports and graphs and things like that to know that you're doing a good job monitoring your business. Is just a key aspect of management. That will allow you to be aware of emerging problems before they become obvious. Sometimes there are subtle little changes in this number or that number, which will help you understand that, I have to make a change in my business to fix this problem before it becomes serious and my cash evaporates or my collections go out of hand or something goes wrong with the business. The primary reason to watch these numbers is to identify emerging problems. And finally, if you ever want to sell your business, if you have a good set of financial statements, they are worth money to the buyer. They give them confidence that you have been managing your business well, that there's no fraud going on. They also, frankly, good numbers, good assets, good books are an asset to the new business. It's something for them to kind of measure and work against as they take over the business. I would not buy a business unless I felt the business I was buying had good, accurate records to it. So those are some good reasons to do this stuff and keep good records. So here's what we're going to kind of cover tonight. Reports for a firm's financial performance and resources. It helps you determine what you're going to need. So if you are starting to build up a new business or grow your business, and you do these financial reports and then put together a budget for what they might look like for next year, you'll know whether you need an extra $30,000 or $100,000 or $500,000 to grow your business. It also helps you kind of quantify, if you will, the goals in your business plan. So if you want to increase your marketing next year, you've got to put a number behind that. Maybe it's 20,000, maybe it's 50,000, but you can't do a lot of these things without some money to make it happen. And the business plan, the financial reports within the business plan, and your budget for next year are the way you quantify your goals and objectives for the future. We'll cover at length the basic financial statements that everybody must maintain. The two that are most common are the income statement and the balance sheet. We have a number of slides on each of those. And to some extent, we'll also cover a cash flow statement, which can be really critical for seasonal businesses like we often have here in Steamboat Springs. Are there any questions so far? All right. Starting out with the income statement. Right. Let me start by saying that income statements are common in every type of organization, including not-for-profits. The only difference in a not-for-profit is you don't give the money back to the owners, you keep it in the organization. So there's no harm in making a profit in a not-for-profit. It just means you're going to keep it in the organization to serve your mission to a greater extent next year and the year after that. But basically, it's a report showing the firm's profit or loss for a period of time. The period of time is usually a month, a quarter, or a year, okay? Our business in Indiana did a financial income statement every single month. We needed to know how we're doing. It was our scorecard. It also gave me great fear or confidence as that came out every month, and I could stay on top of our numbers. Many people do them quarterly. In seasonal business like Steamboat, there tends to be a, kind of a summer quarter and a winter quarter that can be very profitable. The other two can be break even or even at a little loss. But an income statement is a fixed period of time, 1 month, 1 quarter, or 1 year. Sales less expenses equals profits. Pretty simple formula. What have you sold? What kind of income have you brought in the business? Less the bills you paid equals profits, hopefully. It's very possible, particularly for a new business, that you'll have a loss, or in a difficult year like this, that it will be a loss kind of year. That means the expenses exceeded the sales. Sales are revenue from the sale of products or service. We have many businesses. What would be an example of a business that sold services and product? Anybody want to throw one out there? Ah, you're shy. A hair salon, perhaps. They sell all kinds of skincare products, shampoo, something like that, but they also provide service. Cost of goods sold. So if you were running a hair salon, the cost of the shampoo, skincare products, whatever else that was sitting on your shelves would be cost of goods sold. If you're selling titanium bikes at Moots, the raw materials you buy, the titanium, the components that go on it, the welding metals, would be cost of goods sold. If you have a retail store in town, the products that you fill your shelves with, that you put on hangers perhaps, is all cost of goods sold. And that's the price you pay the vendor to buy that stuff, whether it be raw materials or finished goods, to move into your facility to resell to other people with some type of markup on it. Okay? And then their operating expenses are all the other expenses. Insurance, marketing expenses, that could be your website, selling expenses, commissions, literature, anything you do to generate sales would be an operating expense. General and administrative expenses, bank fees, lawyer fees, web developer fees. There's a ton of them out there. You probably can come up with a list of 20 or 30 items that you have to spend money on: rent, payroll, all these kind of things would go under operating expenses. And then finally, financing costs. Many, if not most businesses, borrow some money to run their business. There's a separate line item on the income statement for the cost of that money. And whether you pay a 4% interest to your local bank each year, or you have a mortgage and you have to pay money on the mortgage, the interest needs to be identified and clearly set forth as a financing cost for that business. Can't get away from taxes. What do they say? Death and taxes are a certainty. Everybody has to pay taxes. Most all of you are subchapter S or LLCs, and those tax payments have to occur before you can take a distribution. The exception would be if you're a not-for-profit, the taxes there really aren't the same. But tax payments need to be considered in the income statement too. All right. So all the stuff we bring in, if you're a landscaping company, the cost of the trees you buy or grow, the cost of the mulch you buy or grow to distribute out to the community, to your customers, is a cost of goods sold. What is not a cost of goods sold is services. So if I bring an electrician out here to work on my home, his time is not a cost of goods sold. However, any supplies or equipment that he sells me or installs in my home and charges me on an invoice is cost of goods sold. So pure services, accounting fees, legal fees, web developer fees, those are basically operating expenses further down on the income statement. But if there's a physical product that is being repackaged, improved upon, added to, or even put on a shelf and just resold at a markup for convenience and choice, that is a cost of goods sold. If you're running a retail store, it's very important, if not fundamentally important, that you manage your cost of goods sold at retail stores to be able to generate the kind of gross profit that allows you to run the business, okay? So the gross profit is those sales, whatever revenue you bring in, less the cost of goods sold. There is really no gross profit for a pure service business. In that case, it would be sales less operating expenses, okay? Gross profit is when there is a cost of goods sold that exists, a physical product that requires you to invest in that product before you resell it to somebody else. Operating expenses really are, again, anything else other than the inventory that you're buying to sell to other people, okay? You can, again, create a list of many, many items that would fall into that. Your businesses are all different. Many of you have software, computers, all kinds of things that would fall under operating expenses. And that, when you do the math and you subtract revenue less cost of goods sold to get a gross profit, and then subtract the operating expenses, you eventually will have an operating income. That is the money that your business makes before you spend money on interest and taxes. I've got some pictures here too. All right. Before I get to the pictures, financing cost, if you borrow money from lenders, show your interest here, okay? That results in a net income available to owners. That is money that you can take out at the end of the year, end of the quarter, or even end of the month and distribute through what we call a draw to your ownership, whether it be you, other family members, or other people that have invested in the business at the end of this period of time, monthly, quarterly, or year end. At my business in Indiana, we distributed probably in February every year after we closed the statements at the end of December and made a board decision on how much money we're going to give back to the ownership of our profits for the prior year. Okay. Is anybody familiar with the term of depreciation expense? Chancey, you probably have some really fancy computers that cost a lot of money in the work you do. And I assume that you write those off every year and you reduce the value of those computers. And some of you may have trucks for your organizations. Okay, some of those trucks can be $40,000, $50,000. You buy that truck, but you don't write off the whole value of the truck the year you get it. Some tax law allows you to do this, and this is not a tax law seminar, but in most cases, you will write down that asset over a number of years. Computer equipment, cheap stuff, it goes off the year you buy it, but fancy, expensive processors will be written down over a 3-year period. Trucks, vehicles, 5 years. Real estate, I think, is 19 if I'm not, I think. So this is the ability to write down the value of an asset over a period of time, and that does reduce profitability and save you money on taxes. Here's the picture. Okay. So sales revenue here, less cost of goods sold equals gross profit, less marketing and selling expenses, including depreciation, equals operating income. After operating income, we have interest expenses on your debt. If you have any debt, this may be zero if you don't borrow money. And that results in earnings, God willing, in a well-run business, less income taxes, and that's the money you can distribute to your business. Here's another graph of it. And I like this one a little better, actually. Again, we'll follow it through one more time. Sales up top here, less cost of goods sold. And this category does not exist for a pure service business, equals gross profit, less other types of expenses, and your paycheck and your employee's paycheck goes in this category here, equals something called operating profit. And then we take out any interest expense for borrowed money. That results in a profit before taxes, less your income tax, and it's going to be variable depending on your tax rate. And the family income you have equals net profits. Okay. What happens to net profits once it's acute? Once you've decided, paid all these bills, paid your taxes, and then you have a certain amount left over. Well, you have a couple choices there. One, and the most common one, is to take it out. You've earned it. It's your money. But many people will choose to keep some of that money in the business for next year, for a rainy day, for COVID times, for an opportunity to get some equipment that they might need in the future, new vehicle, new assets, for anything, new machinery. That's called retained earnings, and we will cover that under the balance sheet, but I wanted you to think about it. The business I ran in Indiana, we failed to keep enough net profits in our business. We distributed almost all. So when 9/11 came and we had a serious bump in the road, we had to borrow money to pay bills for a while instead of having a pool of accumulated cash in the bank as retained earnings that we could draw from. And it was a bad mistake that I regret to this day. Here's an actual one. This is I think a leasing company by the example, but you can see the numbers here and how they lay out. Yours should look very similar to this. Okay. You may not, if you're just a service business, you may not have a cost of goods sold again, but here you go. Sales less cost of goods sold equals something called a gross profit. Here you go. Off of that comes operating expenses. On my financial statements, we broke these down to many other categories besides marketing, general and admin, and depreciation. So we would have subcategories under this. So I could see the details in these various line items and allow me to monitor that, make decisions, take action to correct trends that were not favorable to our long-term or even short-term success. This is for, kind of academic purposes, so they don't have a lot of categorization here, but you can imagine most of your expenses will fall into this, but not all of them. And for a very small business, you may actually list all of your expenses here. I've seen that many times with people that come to see me. Here we have an operating profit, less an interest expense, resulting in a profit before tax. They've estimated their income taxes at 20%. So net profits are $60,000 on sales of $850,000. In this particular business, they made the decision to pay owners $15,000 in dividends and put $45,000, roll that back into the business through something called retained earnings. Okay. Again, build up that retained earnings. You have more cash, more ability to make decisions in the future without constraint. You don't have to go to the bank necessarily to borrow as much, or maybe not at all, because you have retained earnings in the business to run it in the future. Questions? moving on to the balance sheet. This equation, total assets equals debt plus owner's equity, is the religion of all accounting. Everything has to come to this, okay? If this doesn't work, your financials are inadequate. It's also why accountants make pretty good livings, because it's hard to do at times. We would go through very difficult days trying to get our monthly statements to balance out to this equation. Usually minor errors here and there, sometimes multiple errors in a month, would mean that we just could not quite get this to work. And I'm not talking about $6 errors, I'm talking about $1,000 errors or $2,000 errors, something that's substantial and quantifiable. It has to work. What that basically says is what you put in the business and what you've saved from annual profits, plus what you've borrowed over the years, equals all your assets. Okay, so you look at all these assets you have: cash, receivables, inventory, real estate. Somehow or another, you had to acquire that stuff. And people acquire it by investing in the business up front, which is equity, or borrowing money from a bank, mortgage company, or whatever. Okay. And then as the business goes over time, they may put money back in the business through retained earnings, but the equation always works. Okay. It has to. Balance sheet is a little different than an income statement, though. The key words here I want you to look at is a specific point in time. You may recall that an income statement covers a period of time. I mentioned a month, I mentioned a quarter, I mentioned a year. Well, this looks at the last day of the month, the last day of the quarter, or the last day of the year, because you're measuring specific accounts, specific values on that given day. Okay. Now, many people will look at the differences that have occurred between day one and the end of the month, or the end of the quarter, end of the year, and that will help them see what trends they have in their balance sheet, and they can make good decisions off of that. But the actual calculations come from one specific day. And most times for our business, it was the 30th or 31st of every month. We closed the books on that date, and we produced a balance sheet, and we gave that balance sheet to our bank as soon as it was compiled and accurate. Okay. They required it because we had a loan, and they've got to see this stuff. Why should you do it? It shows you what you have. It shows you whether you have a lot of risk in debt. It shows you the net worth of your business. Okay. If your equity is 100,000, your business is worth, give or take, $100,000. Now, somebody might pay you more than that if there's a growth factor and some opportunity to take advantage of this for the future. But that represents the real kind of cash value of the business. Here's an overview of a balance sheet without the numbers. A couple key things I want to cover here. Note the word current. It's up two places here. Right here, current assets, and here, current debt. Current generally reflects something that is less than 1 year. If it's a current asset, means it can be turned over into cash, or will be turned over into cash in less than 1 year. Cash is cash, it's what's in your bank. That would also include things like your checking and savings account. In many businesses have accounts receivables. That's what people owe you. Okay, you have extended terms to them. My old business, we gave people net 30 days to pay, and because we sold to business customers and they required that. I didn't want to do it. They required it. Many people in many trades require some time to pay their bills. If you're a ski shop and you're acquiring skis, hardware, software, clothing from vendors, North Face, Patagonia, all the other companies, Burton out there, those suppliers that actually send you inventory will give you time to pay that inventory back. Okay. In many cases, they'll give you 60 or 90 days because they know your season doesn't start for another month or two when they ship you stuff. If you're a landscaping service and you're billing mountain resorts probably has 2 weeks to 4 weeks to pay the landscaper for that fee. Now, if you're the landscaping service and you're billing me, you may require a credit card payment, so the payment gets done quickly. The business-to-business transactions often include some level of accounts receivables. And then, of course, inventories. I mentioned moots. They got a wall full of aluminum or titanium tubing that probably is worth $100,000 or more. Very expensive stuff. That's their inventory. They have lots of other stuff there too. You know, a hair salon has a wall full of shampoo products and hair products. Any kind of store has shelves and hangers full of goods that people can buy. That is inventory. Fixed assets, machinery and equipment. That would be very large computers, not the usual, the small ones that we have, which frankly would be expensed as soon as you buy them. But these fixed assets have many years of life and are depreciated over the life of the asset. Your vehicles are fixed assets. Any real estate you may have is a fixed asset. Any land you've bought is a fixed asset, okay? For a store or a restaurant, that's a good example. The coolers they have, all the cabinetry and the ranges and stoves, those are all fixed assets. If you have a retail store, the fixtures, the things that go on the wall that allow you to display stuff, it has a multiple year life, so it's a fixed asset. And then those are depreciated over time to reduce the value in a IRS procedure that allows the particular types of assets to be written down over a particular number of years. Other assets would be long-term investments. Let's say you bought some stock or you've bought some real estate, some land for future development. Those would be examples of long-term investments. Patents, copyrights, trademarks that have financial value. Much more difficult, I should say, to determine the value of those patents. But once you do, this is where they're going to be listed on your balance sheet. And of course, that totals up to total assets. On the right side, the equation that must equal, and again, here's the word equal, is debt. Current debt is stuff you owe within 1 year. Payables, somebody sent you a bill you haven't paid yet for whatever it is you want to buy. Accrued expenses, that might include taxes you owe but haven't paid yet. It might include payroll you owe but haven't paid yet. Okay, there's a lot of things that we know we owe in the books that we haven't written the check for or sent the money out. Short-term notes, that is generally the most current portion of your bank loan. The portion of your bank loan that's due within 1 year, okay? Whereas long-term notes is the longer portion of your bank note, okay, right here. So if you have a 5-year bank note, what's due in the next year is here. What's due from years 2 to 5 is here, okay? Mortgages, if you bought property and you financed it and put a lien on that property, it's a mortgage. Your home is, of course, is a mortgaged property in most cases, not all of us. But many businesses also mortgage their business property too. It's one of the best ways to get capital, and one of the cheapest ways to get capital to borrow from a bank is to finance the property you're building on. Previously, I've talked about ownership equity. Okay, that is what you put in the business to start. Let's say you wrote a check for $30,000 and put it in the bank up front to start your business. That's the first piece of owner's equity, is what you originally invested. The next piece is the money you saved and not given back through profit distributions over the many years your business has operated. If you happen to lose money, that would be a negative draw on the owner's equity. So over the years, let's say perhaps you've invested $40,000 and saved $60,000. Now you're up to $100,000 in net worth. In this terrible COVID year, you lose $30,000, then your net worth would drop back to $70,000 for the year. That's another reason to have a buffer there, because bad years come to almost all of us. Um, there is a difference between an LLC and a corporation. LLC stands for limited liability corporation, but if you are an LLC, you are a member. If you are a S corporation or a C corporation, you are a stockholder. So it's a subtle difference, but I thought I'd mention it. What do you call, Helen, for example, one of your investors? Did you have a term for investors in your business?
A grantor would be
Grantor.
someone who invests in a nonprofit organization, and our nonprofits are responsible to them very similar as this is responsible to someone who gives them a loan. They give you money for a grant, and they should execute those services and the terms of the grant agreement, and then report back to that funder with what they've done. And while you have me, the nonprofits, typically the balance sheet's called a statement of financial position. It's the same thing with a different name.
Yeah.
I don't know why, but
yeah, just probably history behind that.
Hey, Randy, while we got you, Lorraine asked, can you explain why equity is lumped alongside debt?
They are on the same side, but they're quite different. Debt usually has a priority on profits. So if you make money for the year, you have to pay your debts first. That's a responsibility under contract that you have to fulfill. Equity is something, if there's money left over after paying your debt off and any interest on the debt, is the money left over is the owner's money. Owners might be one person, you, or it might be, frankly, tens of thousands of people, as in many public companies. Okay, I have some mutual funds in my retirement account. I own stock, so I have some, small percentage of Hewlett Packard or Amazon or whatever of the various companies they've invested my money in. The equity, I want to say this, the net worth of these companies is the accumulated equity and the debt, okay? But the debt has priority in terms of getting any cash or profits. It has to be paid first. It has priority. If you sign a bank loan, they're going to put a lien on pretty much everything in your business. They certainly had a lien on everything in our business. Even the clothes I wore to work, they had a lien on it. I'm just joking. And so it's just a prioritization kind of thing. Each of them are investing in your business, the bank as well as the owners that are investing in the business, but the debt has priority, okay? And those two basic categories, debt and equity, accumulated together, have allowed you to acquire all these assets. The assets are what allow you to make money. It's allow you to run your business, to have all the stuff you need to be successful: cash, inventory, facilities, machinery, all that stuff that actually makes you money is because of the right side of this, the debt and the equity. Debt and equity can come in really dramatically different proportions. Some people are able to build a successful business with hardly any debt or none. Others don't have that luxury and have to go and acquire debt from other people in order to build their business. Hopefully they pay it off. Some of us have a greater tolerance for debt. You may not. I have some, but different business owners are willing to take on different debt for different things, okay? A mortgage is the safest of these debt options because it's paid out over 20 or 30 years. Other people will take a bank loan out because they see an opportunity. They want to borrow money. And it's easier to get that bank loan administratively than it is to sell more stock in your business. Finding investors to invest in their equity in your business, if you're a small business owner, is very difficult. It's not impossible, but it's very difficult. They're generally angel investors or venture capitalists. They're looking for a high return. So sometimes you need to get money to build your business, but you can't find equity investors besides yourself. So you go out and borrow money from a bank, a micro lender, an SBA lending partner, something like that, to be able to get the capital you need to buy all these assets to actually make money. Does it make any sense, Lorraine?
Yes, it does. Thank you so much, Randy.
So we're going to look through a couple of these different categories fairly quickly here. I think I'm doing okay on time. Current assets, some of this is redundant, what I've said before. There's a term called working capital you'll hear in conversations with other financial people. It's assets that can be converted to cash within the firm's operating cycle. For some businesses, that operating cycle is 60, 90 days, others 6 months, maybe even a year. Okay, and I'll cover that a little bit more on a future slide, but the operating cycle is the time you sell something, the time you get the cash back in. Okay, so we'll cover that in a future slide. I've got a good graph of it actually coming up soon. Cash, currency and negotiable instruments. This might be a CD. There is no interest rates right now. I was looking to buy a CD for my savings retirement account here recently, and it's like 0.1, not 1%, but 0.1. So it's just, there's nothing out there right now. But and sometimes having a negotiable instrument or a CD, if you have plenty of cash, is a good way to keep your money working for you a little bit. Accounts receivable. Again, my company previously, Star Staffing, had offered our customers net 30 terms. We asked them when the bill came to pay us within 30 days of that. We didn't always get 30 days. And when the bill hit 45, we started making collection calls, and we went through the hassle of, I had an attorney that I had to sometimes engage to collect these things, and they would grow old. We would also, and sometimes, offer our customers an incentive to pay within 10 days by giving them a 1% discount on their invoice. There's ways to minimize accounts receivables, and I do periodically do a workshop on this for people that offer this kind of money. But nowadays, most of us are paying online through PayPal, through a credit card, through Fiverr. There's a lot of services out there that process online payments. So accounts receivables is something that's generally reserved for business-to-business transactions. Okay, businesses still require it in many types of industries. At the end, inventory is raw materials and products held in anticipation of sales. Okay, so you bought something from a vendor, you're holding that until you can sell it to your customers. And it might be a finished good, it might be something that's raw and needs to be built, again, like bike frames. All right, this is the working capital cycle. It presents this much better. You purchase inventory to be sold to customers. And right now, this time of year, many of our retail ski related businesses are getting their inventory delivered. Okay, boots, clothing, ski stuff, all kinds of supplies that they sell to us to enjoy, and to our visitors to enjoy a good season. So over the next few months, we'll sell that inventory. Many times we'll sell it for cash, and a credit card is equivalent to cash nowadays because the transaction goes through within minutes, if not hours. But other times we sell on credit, okay? And again, that's a situation where generally it's business to business. Once we sell on credit, it becomes an accounts receivable for the business. People owe us the money. Eventually we collect that. I mentioned that my previous business sold in net 30 terms. But if you're a tradesperson in town and you send me an invoice as a plumber, for example, you might want net 10 or net upon receipt. Okay, so I'm supposed to pay the bill right away. It doesn't mean I will, but I'm supposed to. It's still an accounts receivable in your book because you've done the service and generated an invoice and sent it out to your customer. Eventually that turns to cash. And this period of time between here, up here, purchase or produce inventory to cash, whether that takes 20 days, 40 days, 90 days, or a year, is your working capital cycle. It's the time it takes to churn out cash from all the transactions that are part of your sales cycle in your business.
Randy, can I ask you a quick question about this?
Sure.
If you're a service industry, it's the same thing. Like if you provide services, say classes for kids, and you provide the services, but you still haven't been paid yet. This is the same thing as working capital here.
Yeah, pretty much.
Okay,
If somebody owes you the money, it's a receivable. And to create that transaction, you have to send out the invoice, or, whether it's via email or print. Once you generate the invoice, it becomes, and it goes on your books, whether it be QuickBooks or Xero or one of many software packages that are out there, it becomes a receivable. And when it's finally paid, that cycle is complete.
great. Thank you.
Oops, one more. All right, this is the fixed asset part of the balance sheet, which is, again, is an asset on the left side. Fixed assets are relatively permanent resources intended for use. These are the things that generally allow you to make a living. Okay, they're the store and the fixtures. They're the warehouse that stores your stuff. They're the small plant that makes bikes. They're the restaurant equipment that allows you to serve your food service customers. It is the fixed assets, the equipment that allows you to run your business and serve your customers. If you have a simple business, and I'd say something like electrician or snow removal service, your truck might be your largest fixed asset. Your tools, which can be very expensive, are a fixed asset. The snow throwers that you use to do your winter work is a fixed asset. Okay. These assets decline in value over time. The accounting term for that is depreciation. Okay. So if you buy a $40,000 truck and you decide to depreciate that over a 5-year life, and the one particular type of depreciation method is called straight line, and that would allow you to write off $8,000 of that truck a year for 5 years. Now, there are other ways to depreciate, so please don't think that's the only way, but that is an example of how we write down valuable fixed assets over the life of it. The IRS will tell you what that asset's life is. You don't get to pick that. There's a schedule for that, okay? Again, the longer the duration, and real estate's the longest, the longer the write-down period for that particular asset. Then there's other terms here, which I wouldn't be too hung up on. Gross fixed assets, that's what you originally paid for the stuff before you write it down. And then all your assets will have some level of accumulated depreciation, which is taken over the multiple assets life. So these are just categories under fixed assets on your balance sheet, okay? To me, these are good reasons to maintain good records of the property you have, to know when you bought it, to keep a little file on everything you spent over $1,000 worth, so that you know when you bought it, what its origination date was, what you originally paid for it. So as you write it down, or as your accountant helps you write it down, you can have good records. And this would be a subject where an IRS auditor would probably look pretty deep into this particular classification here, because it's easy to overestimate your depreciation to avoid taxes. Net fixed assets is the sum of the previous categories. I've covered that. Other assets, this is the hardest one to figure. What is a patent worth? Really, really hard to figure that, because nobody really knows. The government allowed you some protection for some intellectual property. We don't know what kind of revenue that patent will generate over the life of it. And patent lives are very, very long. Same with copyrights. If you write a book or create some really cool artwork, great. You can estimate the value, but it's really hard to come up with it. And goodwill. Goodwill is, let's say I bought one of your businesses. I bought Chancey's business, the architecture business, and I paid $50,000 over the market value of it, whatever that market value is. That $50,000 would be goodwill, because I think I can grow that business and make it even better, okay? So that would be an example of goodwill. Also, again, a kind of a nebulous term, but they do show, this is where they show up on certain balance sheets as quantifiable assets that need to be reflected for lenders and other people that want to see what's going on in your balance sheet. All right. Debt is something every business has. And it can be something, some bills you owe this month, at the end of the month, at the end of the year. Could be something on your credit card. Many businesses have credit cards to pay regular outstanding charges. And on December 31st, if there's still unpaid balance, that's debt. Okay. It's most likely and most common to be a bank loan. There's many types of bank loans. Longer term loans for equipment or real estate, short-term loans for working capital and seasonal needs, for example. But it's all debt. It's something you owe somebody else. And generally it's secured by some assets on the right or left side of your balance sheet. The debt we had a line of credit. It was secured by everything we had. Again, they had a lien on everything in our business. And if they didn't want to call that, they didn't want us to fail, but it did put pressure on us to fulfill our obligation to the bank. Okay. And I did worry about it, but it's the cost of doing business. And we were not overly leveraged with risk, but I did use that debt to help us fund our large receivable balance we maintained. Current debt is the portion of that debt that is less than 1 year in duration. It's also the routine stuff, the bills you got to pay to your suppliers, expenses, maybe taxes due, wages due, short-term obligations that you have not yet paid, okay? And also the short-term notes is the portion of your bank loans that's within the first year from today's date or whatever date you're creating your sheet, okay? Long-term debt is year 2 and forever. I don't know how long your mortgage is. Maybe you got 30 years. But if it's greater than 1 year, it's considered long-term debt. Long-term debt often has less interest. It's cheaper in many cases. Oops, go backwards here. Mortgage is a long-term loan that has real estate as collateral. Simple definition, okay? The next one is more important. This is, I kind of really want you to understand this because it's one I didn't do well with when I had a chance to run a company. Owner's equity. You are the residual owners of a firm. When you put money in to start the business, and everybody puts something in to get a business going, and it can be the cash value of the assets you put in. So if you're a framer and you turn the title of your truck over from Joe Framer to framing in Steamboat Inc.com or Inc., for example, Inc., you now have invested the market value, the blue book value of that truck in your business, and that is owner's equity. Okay, at least as far as the accountant's concerned. Remember, the creditors have first claim on the assets, as I said before. So you got to pay them first. But as an owner, you're residual so anything that's left over after you pay your creditors is your money. Okay. Again, you can choose to retain it in the business here, or you can choose to make it withdrawal, often called a dividend in a corporation. Okay. So you've got this is really important, the original investment, what you put in up front, plus what you've made over any number of years, less what you've paid back to the owners over an equivalent number of years. And that is retained earnings. Okay. So the original investment plus these retained earnings, which in theory should grow over years, is your ownership equity in the company. Ownership equity plus the debt allowed you to acquire all those assets that allow you to actually have an operating business. Okay, that's how the balance sheet works. Spent a lot of time on this. Are there any questions anybody wants to go through? Vic, are you monitoring chat? Because I'm not taking a look at that too much.
Yeah, I'm watching it.
All right, thank
You're
you.
good.
All right, let's see what one of these statements looks like for the same company that we looked at before. So this is a balance sheet for the same company that we had as the profit and loss statement before. It's kind of dated. I took this, this is really a chapter out of a textbook I taught out of for many years. But it's still very valid. The accounting here really hasn't changed much. The software that we use to maintain these books has improved tremendously. But the basics of financial statements and accounting, the rules of accounting, which by the way are governed by something called the Financial Accounting Standards Board, or FASB, are the same. So note this: cash, accounts receivable, and inventory are current assets here. And this particular change from one year to year is $50,000. Okay, and generally it was an increase in inventory right here. Okay, fixed assets, gross, that's the equipment you've bought over the years, and then the write down of it through appreciation is listed here. So the net fixed asset totals are here, and note that that number increased $70,000. So your assets for the year between the 2 years here, and this is probably December 31st, yeah, right here, went up by $120,000. Pretty big growth for this company, more than 10%. How did they finance that? Payables went up by 5,000. So there's 5,000 at 120,000. Short-term notes went up by 20,000 from 60 to 80,000. So total short-term debt went up by 25,000. They also added 50,000 in long-term debt right here by increasing this from 150 to 200. So there's $75,000 in total, total debt increase. And then the final amount of this came from an addition to retained earnings of 45,000. If you remember previously, this company made $60,000 for the year. They distributed 15,000 back to the owners as dividends, and they kept 45,000 to grow their retained earnings. So they added 120,000, which financed an increase in assets of $120,000. So it balances out. This number here equals this number here. Needs to do that. That's how accounting works. A summary. Note the income statement covers a period of time. Most businesses use calendar years for their financials. Not all do, but most do. January 1st to December 31st year. Whereas the balance sheet is a day in time. The day before the year starts, December 31st this year, December 31st this year. We looked at all the categories we have and we totaled them up and we came up with our balance sheet for that particular date. Okay. So you've got the income statement that covers the period of time and the balance sheet that covers the dates on either end of that period of time. And frankly, they do reconcile with a little work. All right, moving on now to a new concept. The third statement is not quite as common, but still matters, and you should be aware of it because someone may ask you to create one at some point. It's a cash flow statement. This really shows the actual movement of cash in and out of the business. Okay, so what I've talked about before had depreciation, it had accruals, things that were accounting terms and reflected profitability, but didn't necessarily reflect the actual movement of cash through the business. This statement does. And it's broken down into 3 categories. Category number 1 is operations. Category number 2 is investments. And category number 3 is financing. So you can imagine each of these has some level of cash transactions. Operations is running the business, selling stuff, paying bills, having a profit. Investments might be something you sell. You buy a truck, you sell a truck. That's an investment. If you buy a truck for 50,000, you sell a used truck for 10,000, that is a change in cash flow to account for investments in the business. And financing might be the line of credit you took out for 50,000 to pay for that, or 40,000 to pay for that truck, less the 10,000 you sold the used truck for. Okay, might be some stock you sold, might be some dividends you paid out of your earnings. These are all financial cash flows, and hopefully I can kind of convey to you how these things play out in an actual statement. This is really important here. Okay, if you're a very small business, and there's probably a few of you on this call tonight that are, you may choose to do your business as a cash basis business. That means you don't record transactions until you get the check or until the credit card for the customer clears. Transactions are only recorded when cash is received or payment is made. So for very small businesses, this is the way many of them do that. Whereas a bigger business or even medium-sized business generally does things on an accrual basis, which means you reflect a sale when the sale's made, even if you don't have the cash yet, because you sent the bill out. Okay, the generation of the invoice is the sale, even though you haven't got the cash yet. Okay, that is the key difference between accrual basis accounting and cash basis accounting. Inventory purchased on credit is a non-cash expense. You owe somebody, but that inventory will immediately go on your books as an asset when if you're using accrual basis accounting. Okay, depreciation is non-cash expense. You don't write a bill to pay for depreciation. It's an accounting transaction to lower the value of an asset and reduce your taxes. Okay, but there's no actual check written for depreciation. You write the check when you bought the asset, and then you write that down over a number of years per IRS regulations. Income tax is accrued each year and is not entirely expensed. So throughout the year, you need to mark down what you think you owe in income tax, so it's reflected on your books on accrual basis accounting, because it's going to be due. So showing it as a bill that's pending on your statements is the right way to reflect this thing. But if it's cash basis, you don't do that. You reflect the bill when you actually pay your taxes. And for most businesses, it's in March, not April. You and I pay in April. Businesses pay in March. Okay, again, there's three ways to do this. Cash flows. One is operations, one is investments, and one is financing. The first one here we're going to cover is operations. It is what your operating income is after depreciation, deducting income taxes, and factoring in any changes in net working capital. So I'm not going to go through this a lot. I've got a better picture of it. But your net working capital is the money invested in your current assets, less payables and accruals. Okay. Working capital is a key term. It's the kind of money you need to survive. And let me say this: if the primary reason most small businesses don't succeed is because they don't have enough cash to do their week to week, month to month, and seasonal business needs. Okay, they may actually make a profit, but they can't pay their bills because they don't have enough cash to pay things. For example, if your customers aren't paying you on a timely basis, you run out of cash, can't pay your bills, all of a sudden things just grease, the wheels of progress stop because there's not enough cash. So working capital is a pretty key concept in this whole thing. The other two categories: investment activities, money that flows into your business through the sale of assets, or outflows for the purchase of assets. Okay. Cash flow from financing, money that comes into your business by selling stock or borrowing money. Borrowing money brings money into your company. Money goes out by paying dividends and interest expenses, or by repurchasing stock. Small businesses don't do this, but big corporations do. They buy back their stock. Okay, so there's less of it. It's a complex thing. They're trying to increase their share values. Here's a graphic representation of this. Cash flow from assets equals after-tax cash flows from operations, less investments in operating and working capital, and less investments in long-term assets. Again, I'm not going to go through this too much. The other terms are operations here and working capital. After-tax cash from operations is your net income, and you add back to depreciation expense because that is non-cash expense, and you add back interest expense because it's not operations. This gives you this number here. Okay. And then operating working capital is current assets less your payables and accruals, bills you have to pay, basically. And let's look at an actual statement here. It'll make it clearer, I hope. Same company as before. Notice it's broken down to 3 categories here: operating activities, investment activities, and financing activities. Under operating activities, you have the $60,000 profit. You add back the depreciation, which again is a non-cash expense, so we want to get that out of there. You reflect adjustments in various categories of assets: receivables, inventory, accounts payables, and that results in $50,000 here from operations in additional cash for the business. Now, that money, it was used plus some more actually to fund an increase in gross fixed assets, which went up $100,000. It's in parentheses, but it's an increase here. Where did the balance of that money came from? It came from financing cash flow. So they added $55,000 through an increase in short-term notes, an increase in long-term debt, and profits for the company, less dividends paid. Okay, so for the year, $5,000 in cash flow net increase in the company, but most of the money went to buy this $100,000 in fixed assets. Doesn't say what it is, but that's where most of their money went. Okay, and they financed it with $50,000 from operations and $50,000 here from cash flows and financing activities. So it's a pretty good way to determine where the money's coming and going from in a company. And if you have a kind of a larger or growth-oriented company and you have a bank loan, you may be asked to maintain these numbers. Okay. And whether you do it, your software does it, or your bookkeeper/CPA does it, cash flow statement is a key financial concept that can add a lot of clarity to how money is moving through your organization. Okay, switching gears again. Skip that. Okay, now we're going to look at evaluating a firm's performance. Okay. So you've got all these numbers here. So they make a lick of sense, basically. So we're going to look at a number of things here. The first one is its ability to pay its debt when it comes true, which is a good measure of risk in a company. Is it a risky company? Does it have a lot of debt? Many of the bankruptcies you're seeing right now out there, many large retailers that are going under, Ruby Tuesdays recently declared bankruptcy. They had a lot of debt. They were risky companies coming into the COVID crisis, and they could not sustain for too long because of the debt. The ones with less debt will probably be able to sustain longer if they can maintain at least a base level of revenues through this crisis. Number two, profitability of assets. are you taking advantage of the stuff you've bought to make a profit on it? Okay. Number 3, the amount of debt the business is using, another risk measure. And number 4, the rate of return on your investment. We have many options to invest our money as individuals here. Investing in a small business often offers the greatest risk and the greatest return. Okay. Again, there's not very much good interest out there, but the stock market's been doing unbelievably well, and God knows why, frankly, but it has been. And so there's ways to make money out there instead of investing in a small business. But if you do invest in a small business and you take the risk and put in the sweat equity, you deserve a decent return on your investment. Okay. And the same goes for a not-for-profit, frankly, but your return goes back to your customers, the people you're serving, the community that you're trying to fulfill some needs of. And that offers other benefits too to the community. So these are typical ratios for the same company we've looked at for the last couple slides in terms of profit and loss, cash flow, and balance sheet. These are every sophomore in business school in college learns these ratios in their finance 101 class. Honestly, I'm a finance major. I studied this stuff in college, and for my company, I tracked these on graphs. So I knew that we were going up and improving or going down and getting worse in these categories and several others that I managed carefully. But right now, I'm just trying to tell you what the basics are here. This is, again, number 1, the ability to pay debt, and the liquidity of your business can be measured by the current ratio. And that is the current assets, again, this is off your balance sheet, divided by the current liabilities. For the Penley and Company, it's 350,000 over 100,000. For almost every industry out there, there are industry norms. Industry norms would be found in something called the RMI books, which our public library has and CMC's library has. You probably can't get this stuff online without paying a subscription, but libraries have these things. Okay, so you're trying to do an analysis and you really want to know how you stack up against others in your industry. And these industry numbers are usually broken into small companies, medium-sized companies, and large companies. You can look and see for my business, which might be a bicycle manufacturer, what current ratios are in that industry, okay? Profitability ratios. Return on assets is your operating profit, not the net profit, over total assets. That shows whether the assets you have in your business are working hard for you, whether you're working hard to take advantage of those assets, all right? Here, this company had $100,000 in operating profits on assets of $920,000 for a return of 10.87%, a little below the industry average. They also measured this same operating profit against sales. What is the margin they're making on their sales? Is it a good margin? Is it a not so good margin? If you're running certain types of businesses, and particularly retail and restaurants, super important to understand what your margin is, what you're making. If you're not making, the substantial margin in retail, you're not going to survive. In a restaurant, cost of foods has to be really below 30% for you to survive. So these kind of basic ratios help you understand whether you're in the game or losing the game. Finally, total asset turnover, your sales over your total assets. How many times are you churning through? How productive are your assets in terms of generating sales to customers? Okay. These 3 profitability measures, if tracked on a regular basis, will help you understand whether you've been successful or not. And we manage these, not manage them, we watch them deliberately and regularly. Okay. Number 3 is another debt question, which goes back to the risk question. Total debt over total assets. How much debt have you taken on to run your company? Penley has done 32.6% of their 32.6% of their assets by debt. The industry average is 40%, so they're a little less leveraged than the average company in their industry. Is that good or bad? I don't know. Kind of depends on the times, the economy, what bumps in the road they face. In good times, that's probably not a problem at all. In bad times, it might mean more risk for them as their sales turn down and they have a tough time making things go. Finally, what is the return on the owner's investment? So you put in X amount of money and you saved through retained earnings over the years Y amount of money. And then your profits for the year were 60,000. Are you getting a good return on profits? Now, if you're an analyst on Wall Street, fundamental question, are you making profits on your business? This particular business is at 9.68% versus an industry norm of 12.5. Who does this matter to? It should matter to the owners. The owners may not give a rat's ass about the industry norms, but they do want to know that they're making a good return on their equity. And they may be satisfied with 9.68%, but it probably determines it's more about the whether they're satisfied, whether they feel like it's making their goals and helping them perhaps fund a profit sharing plan for their employees, give bonuses out, meet their personal financial goals, all these things that net profits help create. Questions? I saw maybe some chat there.
Yeah, Helen put up a nice article on nonprofits that shows these ratios.
Oh, cool. Very good. Thank you, Helen. Here's a graphic representation of some the craziness of running around from and measuring all these things. I like this one. The money invested by your creditors and investors, what creates the wealth or the what allows you to buy assets in the business becomes the firm's total assets here. And they produce sales, which hopefully results in profits and cash. And that allows you to computate a return on assets, which allows you to create, measure operating profit against total assets. So everything ties together with a measurement process, measurement tools. You can see how you're doing against yourself and against others. Make sure you're happy with your results and achieving your goals. When you build forward-looking financial statements, it's called a budget, okay? Any well-run organization looks ahead at their needs for next year, the next quarter, maybe longer term, 3 to 5 years in some cases, and they think, I want to do this, we want to expand over here, add an office in Vail, put an online store up, whatever your goals are, a budget helps you visualize those goals in numbers. Okay, so the term accountants use is pro forma, but it's really a budget. It's statements that project the firm's financial performance and condition in the future. How profitable can you expect to be next year, the year after, given what I project in sales and expenses? What kind of financing will I use to get the money I need to create the assets or to buy the assets to create these sales or these new opportunities, to open up an office, to get 3 more vehicles, to build a online e-commerce platform? Whatever those things are will require money. And you may have money in your business through years of retained earnings. You may borrow it, or you may ask investors to invest more in your business to grow and take advantage of these opportunities. In most cases, it's a little bit of each. Many times it's something you've saved to prepare for the future. It's also something you'll go out and get an SBA loan for or a bank loan. So you don't have to finance all of it. It's a combination of savings and lending, okay? But these things allow you to grow. To do this, to get this money from somebody else, a bank or anybody else, you're going to need proof, or at least a plan of what your numbers are going to look like. Will it generate profit? Will it generate different additional sales? What is the value in this, maybe, let's say, $100,000 investment? And will it return money to you and to your lenders to lower their risk and make them feel comfortable that they're not just throwing money out in the wind, okay? So pro forma financial statements or a budget looking forward is the same thing we've been talking about, but it's looking into the future and estimating what your numbers are going to look like. We do a lot of business plan coaching through SCORE and the Yampa Valley Entrepreneurship Center, and our clients often need assistance looking into the future and trying to create numbers out of the cloud, essentially. What am I creating here? Does this have any basis in reality? Well, these are often based on a certain set of assumptions that hopefully are fairly realistic, okay? They can also use secondary market research out there to validate the assumptions, to think that, certain people are going to buy this amount of, I don't know, dog-related products or recreational related equipment. There's national statistics on that stuff. You can use that stuff to help make your projections. You can use those RMI books I also talked about to say, typical businesses in this industry will look like this. So I'm projecting my business will look like this too, with a couple of years of hard work. So there's ways to build these budgets and pro formas. It does take a little bit of work and some assumptions, and frankly, a little bit of guesswork. But it's expected to be done. And if you want to acquire money from third parties, you'll need to do this. It's also, in my mind, good to do a budget for anything, even your home particular activities. Is what am I going to do next 2 years? Where am I going to be? How much do I want to save? What assets do I need to buy? Do I need to put in my house? I need a new roof here. So we're thinking about that well in advance because it's not cheap. But it does take a family and a household budget to do that kind of thing. Questions? I see more chat.
Nope, just asking if we were going to provide a recording.
Okay.
So you're good to go.
All right. I'm getting down to the nitty gritty here. So this is the hard part. Worst part about record keeping is discipline. I actually used to do a better job with my business record keeping than I did my personal life. I don't know how you all feel about that, but I can get behind at home, but I never got behind at work. Okay, because maybe there was more fear involved, and the numbers were a little bigger too, frankly. But accurate and thorough record keeping is part of any business success. I always say, every Friday afternoon before you have happy hour, spend 2 hours going through your books, or maybe 4 hours if you need it. Okay. Separate your personal and business accounts. You should not be using your personal account to run business transactions through. Set up a business checking account. Get a business credit card. They're usually pretty easy to get. So when you go out and buy stuff, supplies, inventory for your business, you can put it on that business credit account. Makes sense, but balance your checkbook monthly. Record your cash payments. Why? If somebody gives you cash, wouldn't you just throw it in the back pocket, go buy groceries? 3 reasons. One is, if you want to borrow money, if you need to borrow money next year, the year after, a successful business is one that has good sales. And in some companies, when it's easy to pocket cash, your business will not look successful if you don't run it through your books. Number 2, if you want to sell your business, those cash payments that you pocketed will reduce the value of your business considerably. Okay, because most businesses are sold as a multiple of earnings. And if your earnings aren't respectable, there won't be any multiple. If you're multiplying 0 times 3, it's still 0. Okay, if you're multiplying 3 times 100,000, it's 300,000. So the difference in the ability to sell the business is significant by recording your cash payments. And finally, you might get audited. And if there's inconsistencies between your books because of a lot of cash payments that were not recorded, it could result in some heavy fines. Distribute your invoices promptly and follow up on past due, including reasonable payment terms. This is mostly for those that sell to other businesses, but it's very easy for a small entrepreneur to put off doing their invoices, whether they do them on QuickBooks or some other software, or just do them on Excel spreadsheet, send them out, or even print them out. Your cash flow will slow considerably if you don't get those things out promptly. And frankly, some of the trade professionals that I've had the opportunity to work with at my home here, it's taken them weeks to get me an invoice. If I invoice for a few weeks, I'm probably not in a hurry to pay it because you're not in a hurry to get paid. So those kind of things tend to lead to payments in 5, 6, 8 weeks instead of 2 or 3 weeks. And cash is king in a small business, so get your invoices out promptly. There's a lot of good online software tools. Lately, I've been turned on to Xero. I think it's a pretty good tool, and I think maybe it's worth checking out. QuickBooks is the king, very easy to use. They have an online option as well. There's one called FreshBooks. There's NetSuite for bigger companies. Tons of options out there for maintaining good, accurate books. If you hate this kind of stuff, if it's not your thing and you're probably not good at it, you might consider acquiring the services of a professional bookkeeper who will keep your ledger for you. I'm going to say something about bookkeepers. We have some awesome bookkeepers in Steamboat. Never let your bookkeeper sign checks. You always sign the checks. Always look over their work in detail. And make sure at the end of the year you have a CPA look at your taxes, look at the books too. Okay, you need a second set of eyes. You don't turn over something with such high consequences to another person with 100% trust. It's too important. Odds are very small that anything bad would happen, but if they do, they can be catastrophic to your business and also expose you to irresponsible leadership. Okay. That is the basis of what I'm here to talk about tonight. And again, I would encourage you to go through the slides that I've sent you, any notes you have from the conversation, and if you have any questions, feel free to call. Next week, I'm taking my first vacation in 9 months, so I will not be here next week. But call me the week after that, and I'd be happy to help. I hope this has been reasonably worth your time and not too boring. Accounting is not an exciting subject, it's just really important one. If you have any questions right now, I'd be happy to do my best to try to answer them.
Thank you so much, Randy. Really appreciate it.
My pleasure. Let's see if I
Thank
can get rid
you.
of this.
Thank you, Randy. Very interesting.
All right. Seeing there is no questions, or you're shy and you want to talk to me on the side, that's all good. I hope you have a great fall. Be safe, please. Thanks again, Vic, for organizing this. And next month we are doing another workshop. Vic, do you know the date of that thing? Oh, here it is. It is new business startup planning on November 18th. I'll be working with Vic on that. And if you're interested, please feel free to contact me and we'll get you a link for that too. And finally, on December 16th, we're going to partner on a marketing plan for startups seminar as well. Have a good night. Peace, everybody. Take care.
Thanks, everybody.
Thanks,
And you'll
guys.
see there is a link for the recording in the chat if you want to get that, but if you missed it, feel free to email me. Thanks, Randy.
Bye-bye.
Take care.